Hi, everyone, and welcome to this webinar on managing legal implementation risks in transfer pricing. I'm just going to give others a minute or so to join as well, and then we will start properly. So thanks very much. Great. Well, we're a minute in, so let's kick things off. So welcome again. Hopefully you're in the right place. So we're talking about intercompany agreements and the legal aspects of transfer pricing compliance. Our agenda today covers three things. Firstly, it's just a brief recap on what are ICAs or intercompany agreements and why do they matter. Secondly, we'll have a recap on some just fundamental points about intercompany agreements, including what the OECD transfer pricing guidance says about the role of agreements. And then thirdly, we'll talk about practical approaches to keep your intercompany agreements in order and audit ready. So before I go on, I'd just like to introduce my colleague. So we have Sean Russell, who has joined us recently and will be helping out in terms of some of our polls and audience participation questions. So thank you, Sean. And we've also got Hina, who's joined us recently as well and as part of our overall team here at LCN. So just a little bit of housekeeping. We will share the slides by email after this, so you don't need to worry about keeping notes as we go. And we'll also do our best to share a recording afterwards. It will just take a few days to make sure we've edited out the bloopers on my part and get it ready for sharing. If you do have any questions, then please do raise them. We have set aside a slot at the end for that, but please also, you can use the chat or the Q&A function to flag your questions as we go along. So just a little bit of a recap on who we are at LCN. So we are actually corporate lawyers by background. We're corporate lawyers who specialize in the legal aspects of transfer pricing compliance, which means that we look at two main things. Firstly is we work alongside transfer pricing professionals in making sure that the legal fact pattern is properly understood and is factored in the economic analysis. And we also get involved in the design of agreements and legal structures, working hand in hand with transfer pricing professionals. And we've included on this slide some examples of the advisors that we work alongside. And as you probably gathered, although the three of us on this call happen to be based in the UK, actually it's a global focus. So probably around 50% of our clients are headquartered in the UK, in the US, and the rest are all over, including Europe and Australia, Singapore, and so on. So let's move into the first section, which is about what intercompany agreements are and why they matter. Before we do that, Sean, would you mind kicking off a polling question just to help us understand who's on the call and so we can tailor our approach accordingly?
Yep, absolutely no problem.
Great, thanks. Yeah, so if you could just take a moment to let us know how you would describe your role. By the way, the responses are anonymized here, so it's just the overall statistics which are disclosed. So in terms of what we're going to cover, so we'll cover the definition, if you like, of ICAs. We'll cover common errors and some recent developments internationally, which really highlight the role that they perform. So what intercompany agreements are? So they are legal agreements which document transactions between group entities. Contrary to the impression that is sometimes given, these are genuine legal agreements. So some people say, well, it's all intergroup and therefore it's not a genuine agreement. Actually, In order to be effective, intercompany agreements need to be legally binding. They need to be proper agreements, if you like. Arguably, they form the backbone of internal accountability and external compliance as regards intercompany transactions. And they are certainly the building block for transfer pricing compliance and transactional comparability. And the reason why they're the building block is that, as I'm sure you know, transfer pricing is based on the concept of the arm's length principle or the arm's length standard. And what that focuses on is comparable transactions. In other words, controlled or related party transactions which are comparable with uncontrolled transactions. And the only way to perform a comparability analysis is to actually define what is the controlled transaction in the first place. And that's the role that, or part of the role that agreements perform. I don't know, Sean, what the results look like in terms of like who's attending.
Yeah, so no surprises, but mostly in-house tax and transfer pricing and external tax and transfer pricing. So everyone's welcome.
Great stuff. Okay, so I'm going to move on to common errors that we see in intercompany agreements, because when we first start working with a multinational group, one of the things that we all do is do a health check. So we'll look at what existing agreements are in place. We'll map that against the intercompany transactions and we'll perform a health check. So obviously, common errors include gaps in agreements, so lack of intercompany agreements inconsistent with the actual transaction. So we see that a lot. IP in the wrong place. I'm just highlighting some of the major errors that we see here. And also, we do come across a lot of agreements which are just unnecessarily long, unnecessarily complex. And although that itself does not necessarily mean that they are wrong, obviously the longer the agreement is, the less likely it is that the relevant people who need to review them will have actually bothered to have read all 255 pages or whatever it is. And therefore, from our perspective, having unnecessarily long agreements is definitely a red flag in itself. Moving on to the right-hand side in terms of why this matters, and we'll go on later in terms of some of the broader stakeholders, but clearly we have issues such as denial of corporation tax deductions. So a number of tax authorities, including in places like Mexico and including in Nordic countries, have the general principle that a corporation tax deduction will be disallowed unless it's made in accordance with a contemporaneous and binding intercompany agreement. Other disadvantages or downsides, risks of having defective or missing intercompany agreements include those relating to transfer pricing. In other words, inability to substantiate transfer pricing policies, conflicts between the terms of agreements as compared to the TP policies, leading to the transfer pricing documentation being disallowed. And we have some classic examples of that on the next slide. And ultimately, one of the risks is that if you haven't analyzed the legal aspects of the transaction properly and you haven't documented it by appropriate agreements, then arguably you've jumped the gun in terms of your benchmarking and your transfer pricing analysis. So you may actually be analyzing the wrong transactions and you may be wasting your transfer pricing compliance costs. We put in on this slide some examples of recent case law and recent developments internationally. Again, I'm not going to go through all of these points on the slide, but one comment that we sometimes hear mentioned is the idea that from an in-house tax function perspective, they're almost hoping for a mini disaster so that they can justify the budget in terms of upping the level of their transfer pricing assurance and including in that dealing with their intercompany agreements. What I would say in relation to that is that we have plenty of examples of genuine disasters which have affected third parties. And I'd say it's a bit like saying, well, we're just like a mini mini fire at home, and once we've had that fire, then we'll justify the cost of the smoke detectors. Unfortunately, that's not a responsible way of managing your own affairs or your corporate's affairs. So I would say out of this list, the classic ones or the classic examples that everyone needs to be aware of are Coca-Cola. So this is the 2020 decision of the US tax court, which is still being litigated right now. And the key issue there was that over a period of time, Coca-Cola operated a kind of profit split. But during that period, its agreement totally failed to implement that profit split, and in fact contradicted the transfer pricing analysis underlying that profit split in certain key factors, including, importantly, the treatment and the ownership of intangible assets. And what the US tax court said was, sorry guys, it's a one-way street. You as the taxpayer don't get to disavow or overturn your own agreements using economic arguments. It's only the IRS that gets to do that. In other words, once you have created your own agreements and exercised your pre-choice in relation to that, then that's something that you cannot easily overturn. And in fact, that was the same analysis in the JP Morgan case, which was a VAT case, which is a similar situation. In other words, the taxpayer attempting to bring issues to overturn the analysis of transactions presented by its own agreements. I saw a couple of messages saying that people were having difficulty hearing. I assume, Sean and Hina, that you can hear okay and is coming through fine.
Yeah, I'll find it alright.
Okay, fine. Other developments that I'd just like to highlight would be in Germany. So that's both the 2023 update of its administrative principles on transfer pricing and the new requirements as regards the transfer pricing matrix. So what the 2023 principles really emphasized was that the relevant point of time, or point in time rather, for applying the arm's length principle is actually not the date when the relevant control transactions happened. It's not the date when the transfer pricing master files or local files are prepared. It's actually the date of conclusion of the relevant intercompany agreement. So it's a strict ex ante approach to transfer pricing compliance, which is certainly applied in Germany and in various other European countries as well. And just touching on the new matrix requirements in Germany, which applied as from 1st of January this year, this is a requirement for taxpayers to disclose a matrix, a summary matrix of intercompany transactions, and that is an automatic obligation to disclose that within 30 days of inception of a tax audit. And that matrix includes a breakdown of each intercompany transaction, the volumes involved, the parties involved, and also the contractual basis of those transactions. So it's just an indication of how the transfer pricing environment has tightened up in recent years. And it's basically not viable to attempt to reconstruct intercompany agreements after the event. It's something that needs to be looked after on a contemporaneous basis, in fact, on a forward-looking basis. So I'm going to pause at this point and Sean, ask you to bring up the word cloud, please.
Yeah, so we thought it'd be fun to have a word cloud. And essentially, in one word, how would you describe the current state of your ICAs for the last financial year? We'll try to keep it PG, but obviously all names are hidden.
Yeah. Yeah, and so when it's referring to the last financial year, that would mean that, for example, if you operate on a calendar year basis, so right now we're in 2025, what is the state of your agreements right now in relation to transactions in 2024? So I can see we're getting some responses through already. Whoever said okay is good. So thank you for joining on that basis. Work in progress. I would say generally a lot of corporates are in catch-up mode, not only with intercompany agreements, but with transfer pricing compliance generally, and very often additional requirements like Pillar 2 or preparation for exit or IPO, providing an additional driver for groups to get their act together. Okay, so I'd like to move on and just talk about some fundamental points regarding ICAs that really everyone needs to be aware of, whether you're in-house or whether you have a transfer pricing or tax advisory role. So just a quick recap on the 2022 OECD transfer pricing compliance guidelines as they relate to agreements and legal issues. So as we all know, master files, transfer pricing master files must contain a list of intangibles. In other words, a breakdown of the different categories of economically significant intangibles. And what is often missed out, that breakdown also needs to contain a summary of which entities legally own each of those categories of intangibles. So it's not just jumping straight to some kind of economic analysis. It's actually identifying, well, what are the intangibles? What are the legal rights attaching or associated with those intangibles? And how are those rights actually owned by the relevant entities? And of course, a list of important agreements related to intangibles. So that's not just IP licenses or R&D services agreements. It's also any agreements where intellectual property or intangible assets has an important role. So that would generally include things like profit splits, CSAs, distribution agreements, and so on. And then moving on, obviously local files must contain copies of all material intercompany agreements. And in case you're wondering, agreements are still required even for transaction types such as low value adding intra-group services or amount B distributors. And part of the reason for that is that the agreements provide evidence that the group has actually elected to apply that approach, such as low value added intra-group services to those particular transactions, and also evidences how the group is applying that approach. So for example, when you talk about a 5% markup, well, it's not just about saying a 5% markup is applied to these services. It's also, well, which kinds of costs should be treated as pass-through costs and are not subject to that markup. And also, where appropriate, specifying the actual allocation key, because both those two factors, treatment of pass-through costs and the allocation keys, can be as significant, if not more significant, than just the markup itself. So just moving on a little bit more in terms of the OECD basic. So I'm sure you'll be all familiar with the 6 OECD steps for delineating a transaction with respect to risk. Obviously, the first step is identifying the economically significant risk with specificity. And then step 2 is to determine how those specific risks are contractually assumed by the associated entities, which means actually looking at the intercompany agreements which were enforced during the relevant period. And of course, bear in mind that the OECD TPG are primarily intended as after the event guidance for tax administrations and corporates when resolving issues after the event. In terms of the actual task, which groups and advisors are facing, is to design and implement transactions in advance. So that means that following this process, actually designing agreements in draft, including the contractual allocation of risk, is a key part of the steps. And the problem is that if you just jump straight to item 6, which is pricing and benchmarking, you've actually failed to describe and understand what is the economic nature of the transaction, and therefore what is the appropriate return for the relevant parties. And just on the right-hand side, we've included some quotes regarding the importance of intercompany agreements as part of the evidence that tax administrations need to look at when they're assessing transfer pricing issues after the event. This mini case study is just cut and pasted from the OECD guidelines. It really illustrates how the presence or impact of just one clause can affect the economic analysis and therefore the appropriate arm's length return for a particular party. This particular case study deals with inventory risk. So as between a principal and a distributor, this is the risk that a distributor may maintain stocks of products, but then be unable to sell those products due to, for example, lack of demand or something. So what a buyback clause is a clause where the principal is saying to the distributor, please maintain stocks of products in your local market, but don't worry if you can't sell any item of inventory because we'll buy it back at cost if you can't sell it. And so that clause, provided that the principal has sufficient financial substance, that clause will actually move the inventory risk away from the distributor and up to the principal. And as you can see from the highlighting in yellow on this slide, based on the OECD guidelines, the presence or absence of that one clause can make a 20% difference in the arm's length return that a distributor should earn in the context of this transaction. And this approach from an OECD perspective is absolutely in line with guidance from tax administrations such as HMRC in the UK, which has issued statements such as contractual allocation of risk can have independent value. So separately from functional analysis, contractual terms can have independent economic significance. There are similar statements in the IRS guidance which require that transfer pricing documentation needs to explain why the analysis of risk in the TP documentation is consistent with the agreements. So that alignment is absolutely critical here. Just in terms of basics before we move on in this section, obviously transfer pricing is an important risk. It's often regarded as the number one tax risk for multinational groups, but it's not the only risk, and it's not the only stakeholder in the design of intercompany transactions. So better way to look at agreements is that they perform the role of a central point of truth or a central reference point in documenting what is the nature and pricing of a related party transaction. And that description, so those commercial and legal terms, perform a reference point not just for transfer pricing analysis, but also for the various other stakeholders, including corporation tax deductibility, withholding tax treatments, customs and tariffs treatments, and so on. And that is why we always say that the design of intercompany transactions and the design of agreements requires a holistic cross-functional approach. In other words, it's important before you firm up on the terms of a draft agreement to make sure that you've identified all the relevant stakeholders and that you've taken on board their requirements in a proportionate way before the agreements are finalized and signed. So moving on again quickly in terms of like the basics, the fundamentals of intercompany agreements. On the left-hand side, what should you be thinking of in terms of the basic requirements for intercompany agreements in order for them to be robust and effective? And remember that when we're thinking about effectiveness here, the critical test is when the tax audit comes in 5, 6, 7 years' time, will they support or undermine your tax positions in terms of transfer pricing, withholding tax, and so on? So just going through these basic requirements. Number one, the agreements obviously need to be aligned with the legal fact pattern. They need to be aligned with the transfer pricing policies. And we think of this as being in four main areas. One is, what is the nature of the transaction? So is the transaction's character described in a common way in the agreements and in the TP documentation? What's the allocation of risk in the agreements? Is that aligned? What's the treatment of intangible assets? Is that aligned? And finally, the pricing, is that aligned and legally binding? Next point is, as discussed, the agreements need to meet the needs of the wider stakeholders. They need to be clear and unambiguous, and this is an express requirement as per various local guidance that has been issued, including in places like Germany and Austria and so on. Clearly, they need to be legally binding, otherwise they are not an agreement. They need to be signed and dated. So unfortunately, draft agreements which are unsigned will not take you very far. They need to be contemporaneous, and they need to be as short as possible without sacrificing functionality. In other words, our philosophy is very much to avoid unnecessarily long and complex agreements and to make sure that they are specific enough to express the commerciality of what's happening, but not so specific that they need to be updated every 3 months or something just because a small operational change has happened in the business. And on the right-hand side, typical issues that we come across and that we routinely deal with is, well, the tension between localization of agreements, which can be needed, as opposed to standardization of agreements across the board, which is certainly an aid in reducing the admin task. Other issues are, well, when is it appropriate to have multi-party agreements as opposed to individual bilateral agreements? There can be challenges in documenting target margin arrangements, so how to specify the range in a legally binding way. Commerciality, commercial rationality, I think is an underlying theme. It's a key reference point for the adequacy of agreements. Regulated entities, so where agreements are regulated, such as in the financial services sector, then generally speaking, regulatory compliance will be the number one issue for the group. So that will trump transfer pricing issues. So that can be a challenge for TP functions to actually get a handle on what the intercompany agreements actually say and what they mean. Analyzing different categories of intangibles and legal risks can be a challenge. And then understanding the contractual impact of different terms as regards risk allocation. So that was by way of background. I'd like to move on to really talking about practical approaches. So what are some ways that actually work for other corporates that they're actually using as regards how they manage their agreements? Sean, can I ask you to launch the polling question on this, please?
Yeah, sounds great. I thought we might also cover one of the most common questions that we get, which is if it's okay to backdate an ICA as long as everyone agrees. I think that's actually been raised in the chat, so it'd be nice to get it in there.
Oh, yeah. Thank you. I think I skipped over that one.
I'll just leave a short timer for this. But yeah, I think we have 73% as no and 26% as yes.
Yeah, and thank you so much for Sean for raising and not forgetting this one. So I would say this is probably the most common question that we get asked. You know, can we backdate agreements? And obviously the lawyer's answer and the tax transfer pricing answer is going to be it depends. From a strict OECD perspective, the guidance is very clear. Risk only has a meaning where there's uncertainty. There's no uncertainty in the past where outcomes are already clear, and therefore you can't contractually allocate risk after the event. It's a bit like, you know, you can't put in your damage insurance after you've had the crash in the car. You can't bet on a horse race after the winner has been announced. So where risk allocation is absolutely central to the economic character of a transaction, then certainly you would want the agreements to be contemporaneous, and backdating would have to come with an extreme health warning. Having said that, the reality is that if you do have gaps or defects in your agreements in relation to historic years, the sooner that you can fix that, the better. What you can't do is you can't create a fraud. So you can't sign and date an agreement now and put a historic date of the agreement, that is clearly fraud and is not recommended in any circumstances. But what may be possible is it may be possible to put in place an agreement now with a historic effective date and recite the fact that this agreement is intended to memorialize the conduct of the parties in terms of their actual historic operations. And of course, the more evidence that you can bring that the agreement that you're putting in place now is actually in line with the prior intentions, with the prior operations, then the more weight that this is going to carry. The difficulty is in terms of how far back you're going to be able to go with that kind of approach, because the further back you go in terms of accounting periods, the more complications you're likely to create for yourself in terms of things like statutory accounting and customs compliance and so on.
Super. And then as it's coming up to Halloween, we thought it'd be fun to see what everyone would like as a superpower in relation to ICAs. So we have mind reading, time travel, super speed drafting, and perfect memory. And I think Paul would agree. I think we like super speed drafting.
Absolutely. So while the results come through on that, I'd just like to start the discussion in terms of what we would regard as the recommended approach for creating and thinking about agreements. So we follow a 5-step process in terms of agreement design and finalization. And not to dwell on the detail too much, but going through each of the steps. So step 1 is scoping out for the particular financial year that you are attempting to document, what is or was the matrix of individual transaction types that you're dealing with here. And by transaction types, I mean things like appointment of limited function distributors, IP licenses, cash pooling arrangements, CSAs. So looking at the high-level transaction types that you're dealing with and mapping that against the entities within the group at the relevant time. Step 2 is the detailed review. So that's the detailed review of transfer pricing policies, existing agreements in place. In some cases, you will need to carry out additional due diligence to make sure that you do have a clear understanding of the relevant categories of intangible assets and the contractual structure of the group and so on. And it's based on that detailed review. It is the task is to create an updated version of the matrix, what we refer to as a data log, which is the numbers behind that matrix in terms of cost plus percentages and target margin percentages and so on. And also a detailed documents list to reflect the legal steps and the legal agreements that will be needed to implement the intended arrangements. Step 3 is drafting. So at this stage, it's often focusing on the interaction between the legal work streams and the transfer pricing work streams. In other words, what you would need to do, or what we would do if we were working alongside you, would be to create a master agreement or template agreement tailored for the group in relation to each transaction type. And the task would be to share that with the relevant transfer pricing team to make sure that the output of this stage is, in effect, a combined view as to what an appropriate legal form would be for each category of transaction. Step 4 is about finalizing those agreements. And so this is the point where you'll need to make sure that you get the appropriate stakeholder input, and that will cover the areas that we discussed, such as withholding taxes, VAT treatment, regulatory compliance, statutory accounting, and so on. And it's also at this stage that you would look at the localization of agreements. Now, when we talk about localization, there are basically 2 types of localization that we may need to happen here. One I would describe as light localizations, and that may merely be changes to the cost plus percentages or the economic, also the numerical variables to take into account the local variations. So, for example, you may have regional benchmarking, which applies to certain entities or certain categories of transaction. You may, for example, have a service provider in India, and the requirement for country-specific benchmarking means that the cost plus percentage for that Indian entity is different as compared to other entities. So that is obviously relatively easy to capture. Other more fundamental types of localization would be maybe where you're dealing with countries like China, where actually the local requirements or expectations or tax environment generally means that actually you need to fundamentally redesign the transaction for the Chinese related entities. And similarly, you may have regulated entities in particular countries where, again, those regulatory considerations will actually override transfer pricing and tax considerations, and you'll have to have specific functionality or commercial terms in the legal agreements. And then the final stage, step 5, is the implementation stage. And one of the things that we're trying to avoid here is a culture or an appearance that just this is a totally tax-led exercise and tax told us to sign here. This is one of the many lessons from cases like SingTel in Australia and BlackRock in the UK and Sketchers in the US, which is it's critical to document the commercial rationale for transactions. And it's critical to actually brief entity directors on what is it that they're being asked to sign, why they're being asked to sign it, what are the things that they should pay attention to before they sign. So it's essential to have a proper process of briefing directors, giving them the opportunity to raise questions before they actually sign. Then it's the process of actually obtaining those signatures, whether it's using DocuSign or whatever, arranging translations where needed, and also complying with specific local requirements. There may, in some cases, be a requirement for notarization. There may be a requirement in some countries like China for agreements to be registered with local authorities. So just pausing here in terms of the results on that latest poll. Sean, any comments?
Yeah, so super speed drafting was number 1, and then time travel was very close second. So yeah, two really useful superpowers for ICAs, I think.
Right. Thank you. So just moving on, and just to illustrate what we're talking about here in terms of the transactions matrix, it really doesn't matter what form this takes, whether it's in Excel or Word or some other form. This is just a simple version that we tend to use for less complex groups. I would say this is the single most powerful tool that you can use. In other words, if you don't already have this on a financial year by financial basis, which gives you a clear overview of each category of controlled transactions, who the parties are, what the pricing model is, what the local variations here are, then you probably don't have a handle on your transfer pricing, and you certainly won't have a handle on your intercompany agreements. So this is the very first thing that we'll ask for, the very first thing that we'll focus on when we're working alongside transfer pricing professionals, whether they are in advisory firms or in-house functions. So this is actually also a key slide, so a key practical problem if you're looking at your agreement from the perspective of being in an in-house team, or whether you're helping clients as an external advisor, is actually working out where to start. So if you imagine a group which operates on a calendar year basis, and you imagine that the group is aware that it has gaps or defects in its intercompany agreements, maybe they were looked at last like 5 years ago, 10 years ago, which is not uncommon. The question is, where do you actually start? Because it can seem overwhelming. So this is obviously going to depend on a case-by-case basis, depending on what your immediate risks are and what immediate problems you are facing elsewhere. But one way of looking at it is on a financial year basis. So here we are in October 25. A a typical starting point would be looking at the immediately preceding financial year, in other words, 2024. You would guess and hope that the group has already prepared transfer pricing, master files, and local files for 2024, but may not have been as rigorous as it needed to be in terms of analyzing the contractual position. So where would you start in relation to that? Well, number one is confirming the transactions matrix. And it's not always apparent from the transfer pricing documentation, because sometimes that takes a functional approach and it doesn't actually break it down by transactions. So this is really the first thing to do, is to confirm that matrix. Number two is to identify the stakeholders, as we discussed. So this is corporation tax, financial accounting, and withholding taxes, and so on. Next point would be to check your existing intercompany agreements and check them for both coverage. In other words, do they cover all material intercompany transaction types as identified in your matrix? And also check them for alignment with the transfer pricing intentions. Obviously, you'll need to fix gaps and defects. Given that we're talking about 2024, it does mean that you're probably in the category of wanting to memorialize the arrangements in that period. So you're creating an agreement which you are signing and dating now, 2025, but recites the fact that you're memorializing those previous, or the arrangements in that preceding financial year. And ideally, in terms of deadlines, you want to do that before the end of this calendar year, because the further you leave, or the longer you leave those gaps and defects unresolved, the bigger your window of risk is, and also the less credibility the agreements have if they're going back more than one financial period. So that's the bucket, if you like, of actions in relation to the preceding financial year. So if you've taken that approach, that means that you can then switch your attention to the transactions happening in this current financial year, 2025, and you can use your previous work as the starting point, which means that what you're doing is effectively reviewing changes to the transactions matrix, to the entities list, and so on, reviewing any new transactions that you've got. So maybe you've got new entities, new business lines, creating updated agreements, and to the extent that you're documenting changes to the commercial terms, then it's documenting the rationale, or what is the commercial reason for making that change. And that is one of the key lessons from multiple cases that we mentioned before, like SingTel, which is where the group failed is it changed its legal term but didn't document why. And that meant that the court was forced to look at, for example, email exchanges between the SingTel group and its tax advisors, saying, should we do this? Should we do that? Yes, let's go ahead on this basis. And it was trying to reconstruct a commercial rationale from a disjointed string of emails, which is obviously, number one, slightly embarrassing, and number two, not very helpful. And again, in terms of the catch up, ideally you want to be moving to a contemporaneous basis. In other words, complete that catch up for the current year before the year has ended. And in any event, well, what is recommended is to get into the situation where your agreements are finalized and locked down and aligned before you finalize your statutory accounts for the relevant year, before you finalize your corporation tax return. Because what you want to avoid is obviously having to restate either of those based on issues that have come to light during that period of review. And then when it comes to looking ahead, transactions for next year, for 2026. So obviously, to the extent that you're planning business reconstructions or hive up of assets or migration of IP, transactions like that need to be documented in real time. So you need to prepare for that with an appropriate run rate. In other words, it takes time to do the due diligence, the analysis, get the stakeholder input, in order to implement those kind of projects. And then moving over to, well, what are the ongoing systems that you need to build in addition to your existing tax and transfer pricing compliance calendar? Well, I guess the most important thing is the first bullet point here is having a central comprehensive repository of signed and dated agreements. It's essential to be clear on what are the roles and responsibilities within the group as regards management of intercompany agreements. Having diarized review points for checking for changes in the fact pattern, changes in your transfer pricing, so that those changes can be addressed on a contemporaneous basis. A lot of the groups that we work with have protocols for making sure that intercompany accounting charges are aligned with agreements, and many actually will have a process so that no accounting charges can be booked unless they're in line with a signed and dated agreement. And obviously protocols for ensuring that entity accounts, corporation tax returns, and TP documentation actually aligns with the agreements as they actually exist. So Sean, I think you had a polling question about the roles and responsibilities question.
Yeah, so our last polling question deals with who owns the ICA process in your organization. So just to see if it's your tax team, your legal team, your compliance team, your finance team, or it might be a separate team completely.
Yeah, and I'd like to, in terms of commentary on that, in terms of what we generally come across, I would say that in the majority of the clients that we work with, it's actually the ownership that sits within the tax team. And that's because clearly in terms of the downsides, denial of corporation tax deductions, double taxation, fines and penalties and so on, basically it falls within the ownership of the tax team. So whether or not they get assistance from other departments, it's often tax that has ownership. Interesting that 40% are coming up as legal. I would say that's not typically the case, but it's there's no one right answer here. The exception, I would say, would be regulated groups, particularly banking, finance, maybe fintech. So because, as I mentioned, regulatory compliance is absolutely mission critical, what we find is that usually it's the regulatory compliance team that has ownership of agreements. It's not uncommon for us to come across groups with literally thousands of intercompany agreements that have been created by their regulatory team. And actually the problem that the tax function faces is actually understanding, well, what do these 1,000 agreements actually say, and how do they sit with the picture that we're painting in our economic analysis? And in terms of what we see, well, in terms of the role of the finance function, it's often the treasury team which owns financial transactions and the documentation of that. I think that's certainly the case, Sean, for the matter we're working with together at the moment in terms of the cash pooling arrangements, very heavy involvement of the treasury team in terms of both that and the related loan agreements that are managed. So I'd say that the takeaway is actually it doesn't matter who owns it as long as it is clearly understood and there's a clear accountability. So before we open up to general Q&A, just to explain how we help, as I mentioned, our role is very much focused on the legal side of transfer pricing. So we don't advise on TP or benchmarking or any of that. It's strictly focused on legal aspects. So what we do are ICA health checks. We have a particular approach and format for health check review of individual agreements or sample agreements. Clearly, we do ICA drafting, so that can be just one standalone agreement, maybe for a more complex transaction such as a profit split or a CSA, or it can be across the board. Matrix design, so where required, we can give high-level assistance in terms of sanity checking or creating the matrix, the intercompany transactions matrix, to make sure that it aligns with the group's contracting model and legal model as regards ownership of IP, because if it doesn't, then it undermines the credibility of the whole transfer pricing documentation. Global maintenance. So for some clients, we effectively manage the entire portfolio of agreements on an outsourced basis. Restructuring projects. So our role for that is generally like international legal counsel working alongside the internal legal counsel and the internal tax function and the external tax advisors. So managing the transaction, and that includes at an early stage proposing alternative structuring options so that a feasibility analysis can be performed from a legal, regulatory, tax, and financial perspective. And then finally, we do provide toolkits and training for groups which do have the capacity within the legal function to do most of the work themselves, but want the additional assurance of starting with an approach and with a set of templates, a set of guidance notes that has been tried and tested, so they don't need to work it out for themselves. So let's just see if there are any particular questions that we can pick up or address. So which other EU countries have this approach? I guess you're referring to the German approach of strict ex ante price setting and the requirements for contemporaneous agreements. So we've come across this in various other countries, including, as I mentioned, Austria, Poland, various Nordic countries. I would say those are the ones that have been most notorious in taking that approach. However, also Mexico, so they have a specific set of rules in terms of evidencing the date of signature of agreements, and the feedback that we're getting through our clients and the TP advisors that they work with is that they do have that default position, which is the corporation tax deduction will be denied unless an agreement is produced which was genuinely contemporaneous. Let me just see if there's any other questions. So I see there's a question: when memorializing agreements, can you use the equivalent of an affidavit of unchanged status? So in terms of the recommended approach and how you would evidence that, our recommendation would be to create the agreement, include in the recitals to the agreement the background in terms of the approach and the fact pattern. In terms of like additional evidence to substantiate the fact that yes, indeed, this has been the way that the group has been operated, that is less easy to define, and it may be a combination of emails, accounting entries, policy documents, and so on. So I would say it was less common to create an affidavit or a witness statement, and are more common to deal with it by partly through the agreements in terms of the recitals, and partly through just assembling as much of the additional evidence as possible, ideally with a date stamp. So I think we're coming to the end of this session, and all I'd like to do is say thank you very much, everyone, for joining. Thank you in particular for your participation, for participating in the polls and the specific questions. As I mentioned, we will circulate the slides and the recording as soon as possible. If you do have any questions that we haven't been able to get to right now, then please do feel free to reach out, and we'll be delighted to have a call or exchange any materials that we can point you to help you on your way. So thank you very much. Thank you, Sean, for being Master of Ceremonies. Thank you, Hina, for joining us as well, and we look forward to next time. Thanks very much.